Welcome back to the deep dive. We really need to talk about yesterday.
We do.
Friday, January 30th, 2026. If you're listening to this and you happen to check your portfolio yesterday afternoon, you probably felt that very specific sinking feeling in the pit of your stomach.
Oh, yeah.
We aren't just looking at a red arrow on a screen today. We're effectively looking at a financial crime scene.
That is not an exaggeration. I've been reading the reports coming out of the major trading desks all morning, and the word bloodbath is, well, it's the technical term of choice.
For once, the hyperbole is justified.
It really is.
It's incredible. I was watching the charts in real time, and it was just breathtaking in the worst possible way.
Uh-huh.
Just to set the stakes for everyone tuning in, yesterday, the financial world witnessed a historic collapse in precious metals. Spot gold fell over 12% in a single trading session.
We're talking about a $600 drop per ounce in a matter of hours.
And silver didn't just fall, it evaporated. It plummeted somewhere between 30 and 36%.
Which, just to contextualize that for a moment, is the biggest single-day drop on record for silver.
On record.
We are talking about approximately $3.4 trillion in market value, just erased in an afternoon. That's roughly the GDP of the United Kingdom.
Gone.
Just gone, between lunch and dinner.
That number is genuinely hard to wrap your head around, 3.4 trillion. And the mission for this deep dive is to figure out why. Because moves like this, they don't just happen in a vacuum.
No.
Assets don't just lose a third of their value unless the world is ending or the rules of the game have fundamentally changed.
Exactly. And that's the puzzle we have to solve today. Was this just a massive bubble finally popping, or was there a structural break in the mechanics of the market?
So what are we looking at?
We have a stack of sources here, breaking news reports from the weekend, some technical analysis from the World Gold Council, and the latest forecasts from the big banks like JP Morgan and Goldman Sachs.
It's a fascinating mess because it involves high-stakes politics, algorithmic trading, and some truly bizarre geopolitics all slamming into each other at once.
That perfect storm.
Let's start with the anatomy of the crash itself. Because what's crazy to me is that gold was flying high just hours before this happened. It hit an all-time high on Thursday, didn't it?
That's right. The contrast is unbelievable. On Thursday, January 29th, gold hit a peak near $5,627 an ounce. It was parabolic.
You couldn't open a financial app without seeing a headline about gold going to 6,000, maybe 7.
It felt unstoppable. And then Friday hits, the opening bell rings, and it just crashes all the way down to around $4,800.
That's such a violent swing. And silver went from a peak near $121 to below $80.
Yes, an intraday drop exceeding 35%. It was absolute capitulation.
And for you listening, when we say capitulation, we mean people weren't just selling because they wanted to take profits.
No, they were selling because they had to.
So what was the pin that popped the balloon? I keep seeing one name in every single headline: Kevin Warsh.
That is the immediate trigger. President Trump nominated Kevin Warsh as the next Federal Reserve Chair.
Okay.
Now, if you're not a Fed watcher, that might sound like just another bureaucratic appointment, but to the market, this was a massive shock to the system.
Because they were betting on someone else.
Right.
They were expecting a dovish pivot.
Exactly. The narrative for months, maybe even the last year, has been that the Fed might lose its independence. The market was essentially betting that the next chair would be someone compliant.
Someone who would slash rates to juice the economy no matter what inflation was doing.
Precisely. The market expected the money printer to go into overdrive.
And if the Fed prints money, the dollar weakens. If the dollar weakens, gold, which is priced in dollars, goes to the moon.
That was the trade, the consensus trade everyone was piled into.
But Kevin Warsh is not that guy.
He is definitively a hawk. He's a staunch defender of Fed independence. He's historically been very critical of easy money policies. He is absolutely not the guy who's going to print money just because the political winds are blowing that way.
So the nomination shattered that easy money narrative.
Instantly. And the reaction was textbook economics, but at warp speed. The U.S. dollar index, the DXY, had its strongest day in 6 months. It rose almost a full percent.
Okay, but let's pause there. The dollar goes up, let's say, 1%. Why does gold drop 12%? The math doesn't seem to add up.
Right.
Usually there's an inverse relationship, but not a 12-to-1 ratio. That feels like panic.
That's the key question. A 1% rise in the dollar usually means gold drops maybe 1%, 2%. It makes gold more expensive for foreign buyers.
It's like 12%.
A 12% drop. Well, that is where the gamma squeeze comes in. The Warsh announcement was the match, but the gamma squeeze was the gasoline.
Okay, gamma squeeze. We see this term thrown around usually with meme stocks, but we need to break this down for the non-quants listening. What exactly happened in the plumbing of the gold market?
So, leading up to this crash, retail investors, hedge funds, everyone, they had bought record amounts of call options.
Right, so these are just bets that the price will keep going up. I pay a small fee to have the right to buy gold later at a certain price. If gold goes up, I make a huge return.
Correct. But here is the catch that people forget. When you buy that call option, there is someone on the other side selling it to you, usually a massive dealer or a market maker.
Okay.
And that dealer, they don't want to gamble. They don't care if gold goes up or down. They just want to collect the fee you paid them.
So they have to stay neutral. They can't just be exposed to the risk of gold shooting up.
Exactly. They have to hedge. So when you buy a call option and the price of gold starts rising, the dealer is mathematically forced to buy some actual gold futures to cover their risk.
So my buying of options makes the price go up, which forces the dealer to buy futures, which makes the price go up even more.
Correct. That's the gamma effect on the way up. It's a rocket booster. It's part of why gold went vertical in January. But here's the nightmare scenario. It works in reverse.
And that's what happened on Friday.
Yes. When the Warsh news hit, the price of gold dipped slightly because of the dollar strength. Suddenly, all those dealers who were holding massive amounts of gold futures to hedge those options, they didn't need them anymore. In fact, they were now overhedged.
So they had to sell.
They had to sell immediately, and their selling drove the price down further, which meant the options became even less valuable, so they had to sell more futures to readjust their hedge.
A feedback loop.
A mechanical, automated doom loop. It wasn't human traders sitting there making decisions. It was algorithms executing sell orders because the math said they had to.
That's why the drop was so fast, so vertical.
And this is where the leverage comes in. The leverage in this market was sky high. Traders were borrowing money to bet on gold because they thought it couldn't go down.
But it did.
As prices fell through psychological floors like $5,300, then $5,000 margin calls triggered automated liquidations. The computers just dumped everything.
Terrifying how fragile these systems can be when everyone is on the same side of the boat.
And everyone was definitely on the same side of the boat. I mean, if we zoom out a bit, the context leading up to Friday is crucial. We have to talk about irrational exuberance. The signs were all there.
I saw a stat in the notes about the RSI.
The relative strength index. It's a momentum indicator. Usually if it goes above 70, an asset is considered overbought.
And where was gold? 80?
It hit 90.
Oh, wow.
90.
That's basically the market screaming FOMO, fear of missing out.
It's an astronomically high level. We haven't seen a reading like that in decades. It basically means the market was completely detached from fundamentals. It was trading fear itself.
I mean, gold was up 65% in 2025 and another 27% just in January.
It went up too fast. It was vertical. But there was another driver, a really bizarre geopolitical one that I found in the sources. Did you catch the bit about the Greenland U-turn?
Yes. I had to read that twice. This sounded like a plot from a Tom Clancy novel.
It really does.
Arctic resources and military posturing.
Right. So earlier in January, the Trump administration was ramping up the rhetoric. They were threatening 100% tariffs on European allies and explicitly hinting at military posturing regarding Greenland.
Which naturally scares the market to death. That sounds like the preamble to World War III.
It terrifies the market. And it added a massive fear premium to the price of gold. People were buying because they were afraid of a transatlantic trade war or even actual conflict.
But then, the pivot.
Right. Just days before the crash at the World Economic Forum in Davos, Trump moderated his stance. He effectively did a U-turn. He walked it all back.
You ruled out military action.
Ruled it out. Suggested diplomatic cooperation instead, so the fear just evaporates.
So the geopolitical fear driver vanished right before the Warsh announcement hit.
Think about the setup on Friday morning. You had the removal of the fear premium, followed by a hawkish Fed nominee, amplified by a gamma squeeze on a market that was mathematically overextended with an RSI of 90.
It really was the perfect storm. You pull the rug out from under the geopolitical argument and then smash the monetary argument.
Yeah.
It's no wonder the floor fell out.
It was inevitable in hindsight, but in the moment, it just feels like chaos.
So that explains the why. But now we have to deal with the what now, because I see some conflicting data here about the long-term drivers. Is the party over, or is this just a massive sale?
This is where we need to separate the short-term panic from the structural reality. Because despite this crash, there is a massive floor under the gold market that didn't exist 20 years ago.
And that is,
for central banks.
They're still buying. I would have thought a 12% drop would spook them just as much as it spooks us.
Not at all. They are buying aggressively. In 2025, central banks bought 863 tons. Look at Poland. They bought 102 tons and have publicly stated they are targeting 700 tons total.
But why? Why are they loading up on gold now?
They aren't trying to make a profit. They don't care about the daily price charts or gamma squeezes. This is non-cyclical demand. They're diversifying away from the U.S. dollar for strategic national security reasons.
What about sanctions, isn't it?
Correct. After watching what happened with Russia's dollar reserves a few years ago, countries realize that if they hold dollars, they are vulnerable to U.S. foreign policy. If they hold gold, they control it.
So a central bank might look at a price drop like this and say, great, gold is on sale.
It's very likely. They have a quota to fill in tonnage. Lower prices just mean they can buy more metal for the same amount of fiat currency. This creates a structural support level, a floor.
Okay, that's the bull case. The floor is in.
Mm-hmm.
But we have to look at the bear case, too. The World Gold Council has a scenario they call the reflation return.
It is the scenario gold investors fear most. The logic is this. Suppose Trump's policies actually succeed. Suppose we get massive deregulation, tax cuts, and the economy starts booming.
Which sounds good for us regular people.
Right. But if the economy booms, inflation usually ticks up. And if inflation ticks up, the Fed under Kevin Warsh will have to hike rates or keep them high to fight it.
Which means bond yields go up.
Exactly. And this is kryptonite for gold. Gold pays no interest. It has no yield. If you can get a guaranteed 5 or 6% yield on a U.S. Treasury bond, why would you hold a shiny rock that pays nothing?
Opportunity cost.
Precisely. In that scenario, the World Gold Council thinks gold could fall significantly further, potentially down to the $3,300 to $3,900 range.
That's a long way down from $4,700. Ouch.
It would be a proper bear market.
But the banks, Goldman, JP Morgan, they aren't buying that bearish view, are they? Their forecasts seem surprisingly optimistic.
No, they aren't. And this is where it gets confusing. Their forecasts, which look at long-term fundamentals, remain incredibly bullish. Goldman Sachs still sees $5,400 by the end of 2026.
Even after this crash?
Yes. They cite private sector diversification. Basically, regular investors catching up to the central banks.
And JP Morgan.
JP Morgan targets an average of $5,055. Their argument is fascinating. They point out that institutional ownership of gold, we're talking pension funds, endowments, is still incredibly low. It's only about 2.8% of their total assets.
That seems low. I assumed everyone was loaded up on gold by now.
That's the illusion of the media bubble. JP Morgan argues that if that allocation shifts just a tiny bit, say, from 2.8 to 3.3%, that massive influx of cash would drive prices right back up.
So the bull case relies on the idea that the under-ownership provides fuel for a rebound.
Exactly. It's a tug of war. On one side, you have a hawkish Fed and a strong dollar. On the other, you have central banks and underinvested institutions. That's the battlefield for 2026.
Okay, let's bring this down to earth for our listeners. If you're out there freaking out because you own gold, or maybe you're thinking, is this my chance to buy? What are the practical takeaways?
First, we have to look at the technical damage. The trend structure might still be bullish long-term, but the parabolic phase is broken. That vertical line up on the chart, it's gone.
The rocket ship has crashed.
It has. We need to watch the 47.24 level. That's where the panic seemed to stabilize on Friday. If that breaks, the next major support is around 45.50.
So applying the old adage, don't catch a falling knife.
Definitely not. You wait to see if that $4,700 level holds. You want to see the market calm down, build a base, before you even think about entering.
What about mining stocks? I saw names like Newmont and Barrick took a beating.
They were decimated, down around 10% or more. This is a cruel reminder that miners are leveraged plays on the metal price.
Can you explain that leverage? Why did they drop more than the metal itself?
It's operating leverage. A mining company has fixed cost diesel for the trucks, wages, equipment. Those costs don't go down just because gold goes down.
So if their cost to mine an ounce is $2,000 and gold drops from $5,000 to $4,000.
Exactly. Their revenue drops, but their costs stay high. That $1,000 drop comes almost entirely out of their profit margin. Their profits shrink much faster than the gold price.
High risk, high reward.
Precisely. Now, there's a really important practical tip for anyone thinking about selling right now. We saw reports of consumers lining up in Paris to sell jewelry.
Yes, panic selling. People seeing headlines and trying to cash out.
But you have to be extremely careful. In volatile markets like this, dealers widen their spreads.
Break that down. What does that mean for the person walking into a pawn shop?
It means the dealer is scared too. So to protect themselves, they pay you significantly less. If the spot price on the screen is $4,700, they might offer you $4,000, or even less.
They're building a massive safety buffer for themselves at your expense.
Precisely. It's predatory, but it's how they survive. So if you rush to sell during a crash, you are getting hit twice. Once by the market drop and once by the dealer's panic spread.
That is a crucial warning. If you don't have to sell, maybe wait for the dust to settle.
Correct. Use trusted dealers, check multiple quotes, don't panic sell.
I guess the biggest takeaway here is about diversification, right? Not going all in.
Always. This crash is the ultimate reminder. Gold is supposed to be an insurance policy, not a lottery ticket.
But people were treating it like a lottery ticket.
They were. Those call option buyers, they were gambling. And when you treat financial markets like a casino, the house eventually wins.
It's a sobering reality check. We witnessed a historic reset, a shift in Fed expectations, amplified by a gamma squeeze on a market that was just too hot.
It was.
So we're left with the big question. Is this the end of the gold rush or just a healthy correction in the longer de-dollarization trend?
The structural trend of de-dollarization hasn't changed. The central banks are still buying. But the speculative froth, that has been blown off the top.
Here's where it gets really interesting for me to close out. We talk about gold as a safe haven. It's supposed to be the boring rock you hold when the world goes crazy.
That's the traditional view, the sleep well at night asset.
But in a world where $3.4 trillion can vanish in an afternoon because of one nomination and some algorithms, is any asset truly a safe haven anymore? Or has volatility just become the new price of admission for everything?
That is the question of the decade. When algorithms and leverage dominate, even the safest assets can behave like risky tech stocks. The plumbing of the market matters just as much as the asset itself.
Something to mull over while you check your portfolio, maybe with one eye closed. Thanks for joining us on this deep dive into the flash crash. Stay curious, stay diversified, and we'll catch you next time.